So I'm going to use the presentation provided by the textbook editor so that it will be aligned with your chapters. And I'm going to start with the content of chapter 1 and 2 for this class meeting. Paula, do you still have a question, or is it an old raised hand?
No, I'm okay. You answered it.
Okay.
Thank
So, as we said, accounting is the language of business. And what we first have to know about accounting, if it is this is your first experience with learning accounting, is that we are going to learn financial accounting, which is different from another language, which is the managerial accounting. Just quickly, what is the difference between the two disciplines? Financial accounting is basically dedicated to external users. Financial accounting, the goal of financial accounting is to produce financial statements. Financial statements are statements that are delivered to the public at large, investors, the bankers, the government, suppliers, customers. These are the financial statements to external stakeholders. And when they prepare, these financial statements are prepared with the intention to be delivered to external stakeholders. And when we say external stakeholders, means stakeholders who are not internal, who do not know what is going on inside the entity. Financial statements are related to an economic entity. That economic entity could be a for-profit, it could be a not-for-profit, it could be government entity. And the manager and the executive who are running that entity usually do not use financial statement to make a decision. They rely on internal reports. Managerial accounting is the discipline that prepares internal reports for managers, for executive. The other difference between the two disciplines, financial accounting is based on standard. It is standardized discipline. There are standards. IFRS standard, International Financial Reporting Standard, or the private entity standard. So when you prepare financial statement, you have to comply with the accounting standards. While managerial accounting, there are no standards for how to prepare managerial accounting reports. There are best practices, but there are no standards. Means you can prepare them at your discretion, depend on your specific needs. So this is the first major concept we have to distinguish between the managerial accounting that is dedicated to internal, and when we say internal, we mean those who are running the business, executive and manager. Those they know the business, they know the entity, and they need specific reports. For example, budgeting. For example, cost. What is the cost for the product we are selling? These are this is the work of managerial accounting. Financial accounting is dedicated to prepare financial statements, and the financial statements are actually prepared for external use, not for internal users. Any questions so far? And again, our course is about financial accounting. We are going to learn how to prepare and how to read financial statement in compliance with the standard, with the accounting standard that are enacted. Okay. Now, In financial accounting, so again, I hope you already made some of the reading, and if you have any question, please do not hesitate to interrupt me. Yeah, go ahead, please. Lee.
Yeah, hey, sir. Just want to let you know that the meetings are not being recorded right now.
It is recorded. In the PowerPoint is recorded on the meeting, not with Teams. Another technique of recording. So I am using the PowerPoint with Camtasia, and Camtasia is recording what I'm saying. So when we finish, I will submit the PowerPoint on Moodle, and when you click on the PowerPoint, you will have not only the PowerPoint itself, but also the recording. It is embedded on the presentation itself. Another technique of recording. Okay? But I agree with you, the meeting itself is not recorded. I don't need to make a conflict of resources, so the recording, I needed to go with the PowerPoint, not with the meeting itself. The previous one, it was recorded as a meeting. Now, and for now on, we record the PowerPoint with an embedded recording inside, audio recorded inside the presentation itself. Okay? Now, we said that under financial accounting, the purpose is to produce financial statement. Financial statements are standardized. There are standards to how to prepare them. The standard cover all the details from the heading of the statement until the way you calculate and the way you present. Unlike managerial accounting, where depend on your need, you can design any kind of report or any kind of spreadsheet, depending on your own need. So because financial statements are dedicated to external users, so users who are not inside the company, the language should be a standard language, a generally recognizable language. So the goal of the standard, the accounting standard, is to establish a language that could be understood by everybody, not only those who are inside the company. So there are many kind of standards. The international IFRS, International Financial Reporting Standard. These for Canadian company, all Canadian companies that are open to public, that for which they have the shares traded on market, on the stock market, they have to comply with the IFRS, International Financial Reporting Standard. A private entity, there is another set of standard, which is the ASPE, Accounting Standard for Private Entity. At your level, you won't see any big difference between the two standards. We won't focus on the difference between the standards. We are going to consider as if they were same set of standard. Where you need to make difference is when you get to intermediate and advanced accounting. At that time, the difference between the two set of standards will become significant. At your level, at the level of introductory financial accounting, we don't see the difference, and we are not going to focus on how different is the not-for-profit standard compared to the private entity standard compared to the IFRS. The financial statements are just four kind of reports, or four kind of financial statement. Statement of financial position, a statement of earning, a statement of change of equity, and a statement of cash flows. And the fifth item is a disclosure. Okay? So every company, every economic entity, whether they are for-profit, not-for-profit, government, city, provincial government or federal government, a department, they all have to prepare to issue, publish financial statement at least once a year. But many do it more frequent than that, monthly or every 3 months, but at least once a year. Every economic entity have to issue or to publish financial statement, statement of financial position, statement of earning, statement of change of equity, cash flow, and disclosure. All of these 4 statements are about dollar amount. A table, a sheet, standardized, the format is standardized, the heading, the content, what it includes, and a dollar amount. In addition to these 4 kind of statements, you also have disclosure, which is a narrative text that come with the financial statement to elaborate with the qualitative data, qualitative information, elaborate on the content of the financial statement. All of what we're going to do at the full period of 6 weeks is how to prepare these 4 financial statements and how to read them, and then how to use them to make analysis and to make decision and conclusion. We are not going to learn how to prepare disclosure, because disclosure are free. There is no specific format of disclosure, narrative text, qualitative information. But we are going to read and learn how to prepare a financial statement, a statement of financial position, a statement of earning, statement of change of equity, and cash flow statement. Every statement has a specific purpose and aims at make specific measurement for the situation or the performance of the company. Statement of financial position, as per its name, financial position, it is related to a specific date. On December 31st, 2022, for example, what was the financial position, which means what was the list of economic resources from one side, and from the other side, the financing of those resources. List of economic resources, cash, account receivable, equipment, land, buildings, that list with their amount, their value, their book value, and also how the list of the financial, how all of these economic resources were financed. Mortgage, bank overdrafts, accounts payable, tax payable, interest payable. So at a specific date, when you have these 2 lists and also the shareholder equity, so this is the statement of financial position, a statement that enumerates the list of economic resources and the financial resources of those assets at a specific date. Okay, we also need a measurement of the performance of the company. The statement of earning is related to is the one or the statement that shows the performance of the executive team, how the company was performant. So and when we say performant, which period of time do you connect performance with a day or a period of time?
Do you mean for the statement of financial position?
Statement of financial position is related to the specific day, we said. How about the statement of earning, which is the goal of the statement of earning is to measure the performance of the company. Can we measure performance for a day, one date?
That would be for a period of time.
For a period of time, yeah, exactly. We show performance after a period of time. That period of time could be 1 year, 1 month, or 6 months, depending on the periodicity of the financial statement. The statement of earning will show the list of revenues and expenses during a period of time. During that period of time, the list of our revenues, the sales revenue, interest revenue, rent revenue, and the expenses, the list of expenses, the salaries, wage and salaries, the purchases, the cost of goods sold, income tax expense, pension expense, the list of all the expenses. That is the statement of earning, which is related, and ends with the net income at the end, of the statement, what is the net profit or the loss of the company. A statement of change of equity, it will show the variation of the equity. What do we mean by equity? We mean basically the contributed capital, the capital that was contributed by the shareholders when they create the company, and also the retained earning, the earning that are accumulated through the activity and that are retained, not distributed as a dividend. The statement of change of equity will show that how those equity items have the variation of those equity items during that period of time. And the statement of cash flows is aiming at measuring the performance of the company in terms of cash generation. How performant is the company in terms of generating the cash? Of course, this is a very quick exploration of the financial statement, and we are going to spend a lot of time discussing each one of the statement and how to prepare each one of them. Any questions so far? Okay. Okay. I'm trying to use my device to move to the next slide. Okay. So let's elaborate a little bit the statement of financial position. We also call it balance sheet. The most popular terminology here is the balance sheet. We call this balance sheet. You will much likely to hear this word balance sheet instead the statement of financial position. Statement of financial position is the IFRS terminology. Balance sheet is the private entity terminology, but both they refer to the same statement. So it presents at a specific date the financial position, which means the assets from one side, and from the other side the liabilities and the shareholders' equity. The assets are, as I said, the economic resources the company used to produce, to generate revenue, and the liability are the external financial debt. Liability means debt, the list of debt that was used to finance those resources, and shareholder equities is the internal contribution provided by the owner of the company. The owner of means the shareholders. That's why we call it the shareholders' equity. And as I said, this financial statement is standardized. So the heading, you have to prepare it in compliance with the standard. And among the requirement is formal requirement, the name of the company, the title of the statement, the date of the statement, and the unit of measure, whether it is $1 or $1,000 or $1 million, depending on how this is presented. So for your project, for example, you're likely to select a big company. So make sure to select a big company for your group project. And usually those companies will publish their financial statement on million or billion of dollar, not on a single dollar. What do we see on the balance sheet? Basically, on the statement of financial position, two sides. So please interrupt me if you have a question. Do not let me go go forward without interrupting me and asking question. The statement of financial position, and again, I remind you that we're going to focus on theoretical concept, not a lot of practice, because already you have recorded videos making, providing you with practice, with example and problems and exercises. When you mix them together, theoretical discussion plus practice will have a comprehensive understanding of the topic. So the statement of financial position is a a sheet that has two sides. One side, even though it is presented in one single column, but conceptually it is about two different sides. On one side we have the assets that are the economic resources like cash, inventory, building. What else? Can you enumerate more kind of assets? Cash, inventory, buildings. What else?
Accounts receivable.
Account receivable, exactly, yeah.
Equipment.
Equipment, yeah.
Paid expense.
Sorry?
Paid expense.
Prepaid expense, yeah. Land, goodwill, investments, software, computers. These are the assets of the company. And it shows the dollar amount, the accounting value, the book value of these items. The balance sheet will show, for example, on December 31st, 2022, cash $200,000. It means at that day we had $200,000 of cash. Account receivable $300,000. It means at that day the total amount of receivable is worth $300,000, and so on. That is one side, the total of the assets. We show our list of assets, the items plus the amount and the total, and from the other side we show two subcategories of financial resources, whether they're external resources, that is the liability, financial from creditors, amounts owed to suppliers, to employees, to banks, to government. These are debt liabilities, and also the shareholder equity, contributed capital, and retained earning. In such way that's the reason we call it balance sheet. It should be balanced. It means the total amount of the asset should always be equal to the total amount of liabilities and shareholder equity. This is the fundamental accounting equation. Fundamental accounting equation is at any point of time, whenever we have a balance sheet for a specific date, total asset, the dollar amount of the total asset should be equal to the total liabilities plus shareholder equity. That is a balanced statement of financial position. Any questions so far? So let's elaborate a little bit on the asset, liabilities, and shareholder equity. So asset, as we said, they are economic resources controlled by the entity. So in order for an item to be qualified as an asset, it should be controlled by the entity, under the control of the entity. If it is not under your control, you can use it whenever you need, and to the extent you need, that is not an asset for you. So asset is not, keep in mind, asset is not necessarily related to ownership. Okay? You may control an asset even though you do not have an ownership title on it. You may have control of a land that you use, and you have full control of that land. Okay, because you are paying long-term rent, for example. That land, if it is under your full control, that is an asset, even though you do not have ownership of it. So you have to disconnect asset from ownership, which is a very common mistake people will do. The list of our assets only includes what we own. That is not correct. That is wrong. The list of our assets includes what we control, what we have control over, not what we have an ownership title on. From the other side, liabilities and shareholder equities are the how was the asset financed. So you have the building, and if you got a mortgage to finance that building, the mortgage is the liability, and the building is the asset. So in the liability and shareholders equity, we list all the sources of financing of the company. Again, for those among you who are new in accounting, we are going to repeat these concepts many times, and even if it look confusing now, progressively you will have a better understanding of these concepts. So we have the assets from one side, and from the other side, how were those assets financial? Two sources of financial: external financial are the liability, internal financial, which comes from the shareholders and from the company itself, that is the shareholder equity. So the shareholder equity, it includes the amount of contributed capital that was injected by the owner, by the shareholders, to finance the activity, okay, and then also the retained earning, the earning that were generated by the business itself. As you run the business, as you sell and you buy, you gather profit, the accumulation of the profit, that is what we call the retained earning. When you distribute part of that profit and as a dividend, that is a non-retained earning. What is kept as a retained earning, that will go in the shareholder equity. Okay. Any questions so far? Please do not hesitate to ask questions. Means you're giving me opportunity to elaborate when you ask questions. I know some of you have never heard about these words before, so there is absolutely no ridiculous question. Our questions are good. I presume that I will go with the assumption that you do not have any prior knowledge about accounting, which means any question that comes to your mind is a good question. I may tell you, okay, that is a good question. I'm not going to answer now because we're going to see this next time, or that's fine. But whatever question you have, do not hesitate. I know there are tons of new concepts, new words that come together, and it is hard to assimilate at the same time, but we're going to repeat and elaborate this many times. So, again, what does the statement of financial position include? To summarize, what do we see in a statement of financial position?
The balance sheet,
assets, liabilities, and shareholder equity. The list of assets, the list of liabilities, and list of shareholder equity at specific date, December 31st, for example. Now, the other statement, the second financial statement, is the statement of earning, or also the statement of income, the income statement, also called the statement of operation or statement of comprehensive income, many ways to name it. This is a statement that is related, as we said, to a period of time, not a specific day. And the goal of the statement, the purpose, is to show to which extent the company was successful in generating value, which means to which extent they generated more revenues than the expenses. During the statement of earning, we enumerate the list of revenues and the list of expenses, and the net amount, revenues minus expenses, that is your net profit. The net profit for the period, the total revenues minus the total expenses. What kind of revenues can we have for a company?
Sales revenue?
Basically, the sales revenue. That is the biggest part of any company. They are here to sell. So sales revenue is the biggest part of revenues for a for-profit organization. If it is a not-for-profit, the equivalent of the revenue is the grants that are collected, the donation that the company, the not-for-profit company, collect. Those are the revenues for a not-for-profit company. So these are the revenues. And then the list of expenses. The revenues with the plus sign minus the expenses. What can we have as kind of expenses? Example of expenses we may have.
Salary expense.
Salary expense, usually the biggest part of the expense in service company. Yeah. What else?
SGA.
Yeah. Sorry, I did not hear you. Can you repeat, please?
General and administrative expense.
Yeah, administrative expense. Yeah. Cost of goods sold. Income tax expense. Tax expense means pension expense, rent expense, insurance expense, utilities. All of these are the expenses. That means that the company have consumed in order to generate the revenue. In order for you to generate revenue, you have to consume some expenses. So that is the list of expenses. So list of revenues minus the list of expenses, that is what you will see on the statement of earning. So that we end with the net profit or the net earning for the period. Revenue minus expenses equal the net earning. The revenues means the resources earned by the company as they deliver the goods or services, and the expenses are the resources used by the company or consumed by the company in order to be able to deliver. So a successful company is a company that generate more revenues than they consume as expenses and end with the maximum of net profit. But it is also okay for a company in start a new business. It is also regular or normal that you start with a negative earning, which means expenses exceed the revenues. That if it is during the first years of your business, that is okay. But for your long-term and long-term range, we expect a company for a business to be successful, they have to generate more revenues than what they consume as expenses, so that they generate net income. Okay. As you generate net income, profit from year to year, let's say we end the first year of business with a loss of, let's say, $10,000. Okay, that's fine. In your statement of financial position, you will have a negative retained earning minus 10,000. In the second year, you make a profit of 50,000. So the accumulated shareholder equity retained earning now is minus 10 plus 50, $40,000. You decide to distribute $20,000 of dividend, so that is subtracted from the retained earning, and you keep going accumulated profit on the retained earning. So retained earning means the accumulated profit that are not distributed as dividend. The company at the end of the period, when they accumulate a profit, that when they get a profit for the year, they can decide either to keep reinvest or keep that profit in the company, or to distribute a portion of it as a dividend. So the dividend distributed is subtracted from the retained earning, so that in your shareholder equity you will only have the retained earning, which means the net profit not distributed, in addition to the contributed capital. That is the capital injected by the shareholders to finance the activity through internal resources. Any questions so far? Remember that the financial statements are dedicated to external users. Okay, they could be investors that are just someone who holds few shares of the company. Okay, and they need to see what happens to the shareholder equity, which means the wealth that belongs to the owner of the company. So that's why we have a specific statement that shows the change of equity. A statement of change of equity will include the equity portion of the balance sheet, the equity item on the balance sheet. You remember in the balance sheet there is liability and shareholder equity, and then it will show the variation, how the beginning of the balance at the beginning of the year plus the increase of the shareholder equity during the year minus the decrease of shareholder equity during the year. So, for example, if we take the contributed surplus, what would be a source of increase of the contributed capital? When would the contributed capital increase? If what? In case of which event?
If most shares are sold.
Yeah, exactly. The company will issue new shares, and shareholders will buy those new shares. So that will be an increase of the shareholder contributed capital. It could be also a decrease when the company buys its own shares. If you purchase your own shares, there will be a decrease in the contributed capital. Now, if I take another item of the shareholder equity, retained earning, what would make the retained earning? We start with the retained earning at the beginning of the year of 1 million. Okay, what would make that retained earning at the beginning of the year increase during the year? With what? It will increase with what?
Profit made during the year?
Yeah, exactly. With the net profit made during the year. And it will decrease with what? What will decrease the retained earning?
Profit made?
The?
Loss made during the year.
Yeah, in case of loss, yeah. But what else?
Pay out dividends?
Exactly. When there is a dividend declared, then that will be subtracted from the retained earning. So the statement of change of equity will show the retained earning beginning of the year plus the increase minus the decrease, which means plus the net income of the year minus the dividend declared during the year, equal the ending balance. For example, we start with 1 million of retained earning on January 1st, plus $200,000 net profit for the year, minus $50,000 declared dividend declared during the year, and then balance would be how much? Opening balance 1 million, net income for the year $200,000, dividend declared $50,000. So the ending balance of the retained earning is the opening balance plus the increase minus the decrease equal the ending balance. So what would be the ending balance in this case?
I didn't get the figures actually.
So 1 million opening balance, net profit $200,000, dividend declared $50,000.
So that would be 1,100,000 minus 50. So that would be 1,050,000.
Yeah, 1 million plus 200,000 for the profit minus 50, 1,150,000. That is the ending balance. This is what the statement of change of equity shows. Any questions so far? Now, so far we've covered 3 of the financial statement: statement of financial position, the statement of earning, and the statement of change of equity. This is how are these three statements are connected. Usually the company will start with the accountant of the company will first prepare the income statement. We first prepare the statement of earning, including all the revenues minus all the expenses. Okay, and now after that we prepare the statement of change of equity. The net income that comes from the statement of earning will show up inside the statement of change of equity as an increase of the retained earning until we get the end balance of the retained earning if there are any dividend distributed, and the net amount will go to the balance sheet. So this is how the three statements are connected. The retained earning or the statement of earning ends with the net income. That net income will be transferred to the statement of change of equity to calculate the ending balance of the retained earning. That ending balance of the retained earning will show up in the balance sheet. This is how the three statements are connected. You see? So this is an illustration example, a simplified statement of earning with total revenues $275,000 minus expenses $252,000. That there is a net earning of $22,000. Of course, this is for illustration purpose only. Of course, a real statement of earning will show the details, not just the total amount. What are the list of revenues and the details, and the list of expenses and their details. So this is a summarized statement of equity. So we end with a net earning of $22.9 thousand. That net earning will show up in the statement of shares of change of equity as what? As an increase of the retained earning. We started the beginning balance of the retained earning is $43,000 plus the net income minus the dividend declared. We end with an ending balance. My question in this illustration, this example, how much was the new, what is the book value of the new shares issued by this company during that period? During the period of reference, what is the book value of the new shares issued by the company?
5.7.
No, that is the beginning balance of the contributed capital. That is not the new shares. That is the existing contributed capital. The answer is none, because if there were any new shares issued during the period, they would be shown here on the statement of change of equity. But as you can see, contributed capital, beginning balance 55.7, ending balance 55.7. That means during that period of reference, 1 year or 1 month, there was absolutely no increase of capital, neither purchase of own shares. So no change in contributed capital. Why am I asking this? Which just to let you understand that the statement tell the entire story. You cannot say, okay, in this statement I don't see any increase in the contributed capital or decrease. Maybe I will find the information in the disclosure or in another statement. No. If you don't see any increase or decrease, that means that during that period there has no increase of the contributed capital and no decrease. The statement tells the full story, the completeness. It is complete. It gives all the information. The net earning is 22.9. The dividend declared is 2 million. There are no other dividend declared. Okay, that's why we end with a, and that $64,000 you see in the retained earning. You can see it then on the statement of financial position, where again simplified statement of financial position, where we only have two kinds of assets, cash and other assets. Total asset $527,000. Now, does this statement of financial position comply with the fundamental equation of accounting, and why? Can you see that this statement of financial position complies with the fundamental accounting equation? Yes, right? As you can see, the total asset, 527.4. Total liabilities plus shareholder equity. So exactly the same amount. Total liability and shareholder equity, $527 and $400,000. So always the statement of financial position needs always to be balanced. What does it mean? Balanced means total assets should always be equal to total liability and shareholder equity. Any question? Now, the statement of cash flows is another statement that describes the performance of a company in terms of ability to generate cash, their capacity to generate cash. Because you may be very successful on generating value, revenues much higher than expenses. However, when it comes to converting that success into cash, because cash is the asset that tells the truth of the success. So that's why we need another statement to measure the performance of the executive in terms of cash generation, because you may be performant in terms of value creation and go and get bankruptcy because you cannot collect all of your account receivable. For example, you are selling at credit, make a big amount of selling at credit, and when it comes to the time to gather the money from the receivable, most of your account receivable are poor quality or poor credit receivable. You are unable to collect the cash, and you get bankruptcy because of this. That's why the statement of earning alone is not enough to measure the performance of the company. It should be completed with another measurement tool, which is the statement of cash flow, that will show the cash inflows minus the cash outflows. Statement of earning, revenues minus expenses. Cash flow statement, cash inflows minus cash outflows. And we split those inflows and outflows, those cash flows, into three categories. The cash inflows and outflows are related to operation. That is your core business, the reason you are doing business. And then cash inflows and outflows related to investing activities. When you buy a new land or new building, or you sell an equipment, that is investing activities. And also the cash inflows and outflows related to financial activities, when you get a new loan, or you pay back an existing loan, or you increase your contributed capital, you issue new shares. That is kind of financial activity. Again, we still have a full chapter about this in one of the coming weeks to go on the details of the cash flow statement. And also, again, as I said, in addition to these four financial statements, can someone enumerate what are the financial statements? Again, what are the four financial statements?
The income statement of earnings or income statement?
Income statement. Yeah.
Statement of shareholder equity.
Okay, a statement of shareholder equity, and then
Balance sheet of financial.
Balance sheet or statement of financial position, and then the cash flow statement, the fourth one. In addition to this, we have to complete all of these statements. These four statements are tables, spreadsheet with items, the name of the item, and the amount, dollar amount. In addition to this, we have to add notes to financial statement or disclosure, where you have a narrative text that gives qualitative details, or also sometimes even quantitative, but prepared otherwise, not on the from another perspective. And that this is not really standardized. The standard will just tell what should be in the disclosure, not how it should be presented. The standard do not prescribe the format of the disclosure, but the standard prescribe not only the content but also the format of the fourth statement, the set financial position, earning, net income, change of equity, and the cash flow statement. Any question about the financial statement? Again, those financial statements, we are going to get back to them and spend much more time doing examples and doing elaborated. This is the first, let's say, a quick exploration of the financial statement. Do you have any question so far before we start the second chapter, presentation for the second chapter? So now what you have to know also is that the standards, what is the goal? Why do we have standards of financial statement? The standard means accounting standard that prescribe the way exactly how the financial statement should be prepared. What does the standard setter, what is the concern of the standard setter? This is what we're going to discuss here. The conceptual framework underlying the way we prepare the financial statement, or underlying the standard that prescribe the way we prepare the financial statement. What is the concern of those who establish, or the setter of those standards? The concern is this: because the financial statements are dedicated to external users, and because those users are external, which means they are not inside the company, they do not know what is going on, they are just putting their money, it means investing their money. So they are vulnerable, so they are the weakest stakeholder, because they don't know what is going on inside the company. And they trust the financial statement to decide whether the company is going well or not. So the standard setter aims to protect those external stakeholders, the creditors or the shareholders, the small investors who are not inside the company, but they just contribute with their money, they put the investment of their life on this company. So these external shareholders need to be protected. So the accounting standards are designed to protect external stakeholders, because they do not have access to the hidden information, to the inside information. They are outsider, and we need the economy to run well. In order for the economy to run well, we need the financial statement to be trustful. What are the rules that we should establish in order to make sure the financial statement we can trust them, are trustful, and stakeholders can rely on them to make decision, to decide whether I invest in company A or company B based on the financial statement. So there should be rules. No matter what is the field of activity, what is this, the business, what kind of business, whether it is service, whether it is a manufacturer, whether it is a real estate company, whether it is software development company, whether it is AI development company, no matter what the company is, the standards are the same. The accounting standards are similar. Those accounting standards are based on the conceptual framework. It is like a constitution. That is the constitution that will govern the accounting rules. So we have the constitution and the rules. The conceptual framework is the constitution. All the accounting rules, which means the standard, have as an underlying assumption the conceptual framework. And the conceptual framework is the philosophy of the accounting. What is behind all of the technique you are going to learn on this course? What is the underlying philosophy behind this? The main purpose is to provide financial information about the reporting that is useful. Useful is the golden word here. Usefulness. The ultimate goal of the financial statement is to provide an information which is useful. What does it mean, useful? An information I can rely on to make a decision. A useful information is an information I can rely on to make a decision. What kind of decision we can make based on financial statement? Give me example of decision we can make based on financial statements. Can we go ahead first. Yeah.
Issue credit or no?
Granting credit, yes or no? I am the bank, and the company is asking for a loan. Am I going to grant the loan, the credit, yes or no? That is one of the kind of the decision, and the bank is an external. They will rely on the statement, on the financial statement, to decide. For example, what should be my, what price should I set to my product? At which I have invented, I am launching a new product to the market. For the first time, I need to decide, am I going to sell it at $1,000 per unit, or $800 per unit, or $1,500 per unit? What is the price? Is this kind of decision a decision that relies on financial statement?
Yeah, it would be, because
How?
your price depends on how much you have to put into the product and the amount of income that you need to generate from it to pay off all the debt.
Can we use financial statement to make this decision?
Sure, it must be, because that will give the outsider a clear vision about what's going on financially inside the company. So they can.
Okay, you're good. That you pronounced the word, the most relevant word to my question, but you use it actually in a way which is not appropriate, which means you said outsider, and you are right. When we say financial statement, we have to connect them with outsider. Now my question, are the outsider, are the stakeholder who decide the price? Is the decision about the price something that is made by outsiders?
What's the question again?
Who make decision about the price? Are outsiders involved in the decision about which price should I use for my product? Is this a
No, the manager would not make it.
no, absolutely no. So this is an insider decision. The executive, the manager, are the one who decide which price is appropriate for our product. So since it is an insider decision, it cannot rely on financial statement. Financial statements are dedicated to outsider only. The kind of decision we can make with financial statement, using financial statement, is not about how much should be my price. It is not about what budget should I dedicate to this new project. All of these are decisions made by insider. They rely on managerial accounting reports, not on financial statement reports. Financial statement reports, again, is dedicated to outsiders. What kind of decisions are made by outsiders? Should I grant credit, yes or no? Should I invest in stock A or in stock B? This is what kind of risk this partner present. what about the solvability or the profitability of that company? This is the kind of decision made by outsiders. So the constitution, which the conceptual framework, considers this ultimate goal, which means to make it this generate an information which is useful for the decision maker. And in order for the information to be useful, there are the characteristics. It should be relevant, and it should be reliable. That is what we call the faithful representation. In order for the information, the qualitative characteristic of a useful accounting information is this: an information should be relevant. In order for an information to be relevant, it should have either a confirmatory value or predictory value, and it has to come at time. The timing, an information that comes at the good time, at the right time, and that allow me to make a prediction, or at least to make a confirmation. That is what a relevant information is. So we have to prepare financial statement in such way that all information provided should be relevant. And it's not only relevant, it also should be reliable, which means this is what we call technically faithful representation, an information that represents faithfully the economic reality. And in order for, these are the two fundamental characteristics. In order for a financial information to be useful, it has to be relevant and also reliable. And now there are also enhancing characteristics, comparability. Information should allow people to compare. Should I invest in company A or in company B? If A and B are in the same business and they make their measurement in a different way, then I cannot compare. So the standard require all companies to measure similar item similar way, so that user of the information system of the information of the financial statement can compare, so that they can compare company A and company. That is the comparability. Verifiability, we can check and audit and verify the information. If they say we have $200,000 of cash, there should be a way to check it and confirm and verify that that cash exists. So that if they say, okay, we have $200,000 cash, but you cannot, for confidentiality purpose, we cannot let you check. So that is a non-verifiable information, and it is not in compliance with the accounting standard. Timeliness, it has to come on time. It means to be available on time. You cannot wait until 2 years to make financial statement. You have to do it at least once a year. But if you are a popular company with 100 and 1,000 of shareholders, once a year is not enough. You have to make to increase or improve the timeliness of your financial statement by increasing the frequency. As you become bigger company, more popular company, instead of preparing your financial statement every year, you have to improve the timeliness by preparing it twice a year, for example. And then, you can get to 4 times a year, every trimester, every term, or also every month, 12 times a year, to increase the timeliness. Understandability also, the information, financial information should be understandable, which means accessible to all the users. You cannot, for example, prepare financial statement on a language which is not accessible to user. You have to make your information statement understandable. So these are the qualitative characteristics of the information. And also the conceptual framework will provide a specific technical definition of what is an asset, what is a liability. The way I define asset for you, that is not the technical way. That is the way to let you understand something concept which is completely new for you. Okay, I would not use the technical definition of an asset for someone who is exploring for the first time. But now, if I take it as an asset as an example, what is the technical definition of an asset? It is much more elaborated, much more complex than the way I presented for you for learning purpose. So an asset is an item which is controlled by the company, which is issued by past transaction. Tawfiq, if please. Yeah. And which is entitled to generate future economic advantage for the company. This is the technical definition of an asset. So in order for an item to be qualified as an asset, so we need a specific technical definition, so that, and those definitions are included in the conceptual framework. What is a revenue? What is an expense? A gain and loss? In addition to that, we also need some assumption to prepare financial statement. Among the assumption of preparing financial statement is the assumption of separate entity. Separate entity means that the economic entity is separate from its owner. You are the owner of the company. To make it easy to understand, to make it understandable, we're going to take the example of you as an individual creating a new company with no partner. You are the only boss, the owner and the boss of the company. Okay? Then, when you engage in business and create a company, you have to consider that your own wealth as an individual is separate from the entity you have created from your business. Your own mortgage, for example, for your house, that is not a liability for your company unless you use your house as your headquarters, for example, and you bring it and you contribute with your house as a contributed capital. If this is the case, then your own mortgage becomes the mortgage of the liability of the company. If this is not the case, your own mortgage as an individual should not be confused with the liability of the entity. This is the separate entity. This is just an example of illustration of the separate entity assumption. The other basic assumption required so that we can prepare financial statement is the stable monetary unit. We presume that $1 in January 1st is worth $1 in December 31st, despite 12 months have expired. And you understand that this is an assumption, which means it is not real. That is not correct. Because of inflation, the value of $1 after 12 months is probably higher than or lower in terms of the capacity of what we can buy with $1. However, we cannot avoid making an assumption that the monetary unit is stable. It has the same worth for the period so that we can prepare financial statement. The going concern is another major assumption. We always presume that the company is going to continue to lead, means the continuity assumption. We cannot make accounting based on the fact that we're going to close, to shut down the business within 1 year or 2 years. Financial statements are prepared with the assumption that you are here to live, to exist, to continue to exist, and not to discontinue business. This has an effect about the way we prepare financial statement. And also there are some principles, many accounting principles that govern the way we prepare financial statement. For example, the revenue recognition principle. At which point of time we recognize the revenue. There is also a constraint of cost, which is included in the conceptual framework. An information has an advantage and a cost. Okay, any information, it has a cost. It is not free. Okay, converting data to information is costly. It is expensive. It requires some resources. So, for example, let's say, what if one would say, okay, we have discussed the timeliness, and we said the best information, financial information, is the one that comes at time. One would say, okay, so then to maximize the timeliness, this criteria, let's prepare financial statement every day. Why once a year? Why 12 times a year? Once a month? Why? Why we don't do it every day? Every day, financial statement, day by day by day. This will maximize the timeliness. Then we will have the information just in time, right? Good idea, theoretically. However, this has a cost. It is not easy to close the books and prepare financial statement on a daily basis. That is crazy. Nobody can do this, even big company. Why? Because the cost of preparing financial statement every day exceeds the advantage. We will maximize the timeliness. However, we will have to pay a lot of money so that's why we have to make a trade-off. We accept to reduce the timeliness in order to reduce the costs of generating information, because financial information is costly. It is not free. You have there are teams who work on it. There are information system, sophisticated information system that should be run to generate those financial statements. That's why we cannot prepare financial statement every day. So usually at least you have to do it at least once a year, depending on how many stakeholders are involved, depending on how large is the population of your shareholders. You may have to do it twice a year, 3 times, 4 times a year, once a month, but not every day. Why? Because the cost of generating information every day exceeds the advantage. Of course, this is just an example of where the cost constraint is involved. Of course, there are many other cases. As we go through the course, I may ask you, why should we use this technique and not the other technique? Which technique, if we have a choice between 2 or 3 different techniques, which one do you recommend? I need you to keep in mind that cost constraint. I need you to give this argument. For example, technique A is better in terms of reliability. However, its cost, it is very costly. That it requires expertise, for example, and it requires expensive expertise. That's why we are going to use technique B, because even though it is less relevant, however, it has a better equation or a better it means cost advantage correlation. So these are the basic elements that govern the accounting principle and the way to prepare the financial statement. Any question for today? So again, our 2 hours class meeting are not of course enough to cover everything, because as you know, this is basically